Great, thank you, and hi everyone. I'm just going to share my screen here if you bear with me for 1 second. Just to confirm, can everyone hear me and see my screen? Okay, sounds like people can. All right, so thank you everyone for joining. I really appreciate the opportunity to speak with all of you. My name is Jay Jacobs. I'm the head of research and strategy at Global X ETFs. We are an ETF manager based out of Manhattan, New York. We manage more than 80 ETFs with over 28 billion in assets under management. Where we've really focused our efforts on the research side and with our product development is in the thematic growth suite, looking at disruptive trends that are happening around the world. And we're going to talk about a few of those trends today. So you've probably heard the term thematic investing before. We hear it thrown around a lot. Sometimes thematic investing is used to discuss trading value over growth, or playing a rising or falling dollar, or changing interest rates. But we have a very specific definition of thematic investing that we're going to use today. That definition is it's a forward-looking investment approach that's trying to identify powerful macro-level trends and the companies that stand to benefit from the materialization of those trends. So it's very much a top-down, bottom-up process. From the top down, what are the key themes disrupting the global economy? From the bottom up, which companies stand to benefit? These are designed to be long-term growth-focused trends that are unconstrained by geographic and sector definitions. Now, we track about 27 different themes at Global X. You can see they range from several in disruptive technologies, changing people and demographics, a changing physical environment as well. We are often asked, how do you arrive at those 27 themes? And really it follows a 3-step process. We look at dozens of themes every single year, and we ask ourselves the questions, do we have high conviction that this theme is going to disrupt the global economy? If we're looking at a technology, we might look at the state of the technology, how it's evolving, what the economics of that technology looks like. Is there a path to profitability? Are there other codependencies on other technologies? We're really kind of trying to tear apart the theme and understand, what is our conviction behind it? Do we believe it's going to disrupt the global economy? The second thing we look for is investability. So a theme can be very powerful, but if you can't precisely invest in it, we don't think it makes sense to bring out in any sort of investment product. So really what we're looking for is a couple dozen pure play companies around the world that provide precise exposure to that theme. Third, we look at time frame. We are trying to identify themes that have a long-term time horizon, ideally over 10 years or more before they are fully played out. So if we hit on all 3 of those different pieces, conviction, investability, and time horizon, then we are likely to really focus on that theme from Global X's perspective. Now, why does this matter today when we're talking about the new normal economy? Well, what we have seen during the COVID-19 pandemic is we have seen a massive acceleration in the adoption of certain themes that we are tracking. And that adoption has changed at different phases throughout this pandemic. So if we go back to the beginning, at Global X, we really identify 4 different periods of this pandemic. The first period being the pre-COVID economy, which is when, from the U.S. perspective, largely it seemed like COVID was emerging in China, but hadn't really reached the United States yet. We were unsure what to make of it, but for the most part, it hadn't really impacted the U.S. economy yet. Then, of course, we moved to the stay-at-home economy. Everyone's very familiar. Lockdowns, flatten the curve, stay at home. That meant work from home. That meant learn from home for kids. That meant entertain yourselves from home. But it forced us to really change our daily lives and change our consumer habits. Next, we've moved on to the reopening economy, the third of 4 phases. And for the most part, many parts of the world are still in the reopening economy today. It is involving phased reopenings. It's trying to balance and return to some sort of economic normalities, while at the same time trying to protect against further spread of COVID-19. But the 4th and final stage that we are just starting to enter in the United States, and I think other countries will be following us soon, hopefully, is the new normal economy. And the new normal economy is when the health risks associated with COVID-19 are largely behind us, but the economic impacts of COVID-19 continue to stay with us for many years to come. So let's go back to the stay-at-home economy, because I was talking about several themes that were accelerated during this unique period. When we talk about thematic investing and we're trying to plot the trajectory of these themes, what we're often looking at is the adoption curve, which you can see in the blue line here. The adoption curve generally starts very slowly as a new technology is introduced into the market. Only a few people start to adopt it as it's very niche. That starts to expand as technology prices come down, the technology gets more proven, and ultimately you start to see a massive acceleration of the adoption of that technology until it starts to taper off because it's penetrated its total addressable market. Now, during the stay-at-home economy, what we saw was that this curve, this blue curve that you see in front of us, started to shift in two ways. It started to steepen, meaning people were adopting technologies faster than they had been prior to the pandemic. And on top of that, the S-shaped curve shifted upwards, meaning it reached a broader addressable market than we ever expected. We can think about that with a few themes that really thrived during the stay-at-home economy. First of all, e-commerce. People couldn't go outside, they couldn't shop in stores, they couldn't go to brick and mortar stores. So a lot of people had to shift their purchasing habits to the e-commerce space. In the United States, we saw 45% quarterly growth year over year in Q2 of 2020, showing that massive shift, that massive adoption of the e-commerce theme during the stay-at-home economy. Similarly, people weren't just shopping at home, they were entertaining themselves at home. So we saw a rapid rise in video game revenues, which rose over 25% in Q2 over the same quarter over the previous year, after mostly single-digit growth rates for several quarters before then. So clearly the stay-at-home economy was a massive accelerant for several themes that were facilitating that ability to shop from home and to entertain ourselves from home. Next, we entered the reopening economy. And in the reopening economy, which in some cases we're still very much in, the mantra has been about the themes that are enhancing flexibility and safety have been those that have really thrived during the reopening economy. In the reopening economy, COVID-19 is not yet completely eliminated. There's still a lot of economic support coming from governments. There's new rules about mask wearing. There's uncertainty around companies reopening offices and travel. So those companies that are providing safety and flexibility during the reopening economy have really accelerated their growth. That includes cloud computing companies that facilitated the ability to work from home because you could access your data or access your software or teleconference with anybody from anywhere. It also includes genomics companies that have really facilitated advancements in mRNA-based vaccines, as well as the testing for COVID-19. So by and large, what you can see is that both the stay-at-home economy and the reopening economy were these very unique periods that very much accelerated these long-term powerful trends in a very short period. So what this means is that we think the new normal economy will have a similar impact, that several themes during the new normal economy could experience that outsized growth that we saw for cloud computing and genomics during the reopening economy, and that we saw for e-commerce and video games during the stay-at-home economy. Now, before I get into which themes are those that we think are likely to be accelerated, what I wanted to talk about a little bit is just what do we think the new normal economy is going to look like? Yes, the health impacts of COVID-19 will likely be behind us. If the vaccine distribution is successful, we think that only very limited localized flare-ups are likely, and the risk of hospitalizations and deaths is much diminished. But we will see certain long-term trends. First, we've seen changed consumer habits during the pandemic that are likely to stick with us for many years. We've seen people increase their preference for digital goods and services, as we were talking about, the rise of e-commerce, the rise of video games and esports. We've seen that people have gotten very comfortable working from home, learning from home, working remotely. We believe that's likely to be more common as companies become more flexible, as employees change their work habits. And generally, we're going to see more people continue to be concerned about public health and safety going forward. Now, on top of those changed consumer habits, we've also seen the weakening of economies around the world. In the United States, we have a GDP output gap of about 1.7% this year. That means that had there not been a pandemic, our GDP would be higher by about 1.7% total. And that output gap is likely to diminish but remain with us for the next 3 years through the end of 2023. So our economy is going to continue to be weakened because of this pandemic. That's carrying through disrupted supply chains and shortages, which has made it difficult to buy cars, to get semiconductors, even to buy furniture. We see high unemployment, but at the same time, we also see a tight labor market as people are uncertain about whether they want to leave their homes and rejoin the workforce. And also, we've seen surging government debt as many governments have had to support their economies and their people through fiscal stimulus and unemployment checks and direct payments. Now, last, we see increased political uncertainty as well. Many of the supranational institutions that were supposed to protect us during COVID-19 have been both under fire and yet are more important than ever before, as we've realized a lot of the challenges facing the world today are not those that can be tackled by individual actors, but need to be tackled by the international community as a whole. On top of that, we also have seen continued rising tensions between the US and China that don't seem to be abating anytime soon. These are some of the macro trends that are going to be impacting the new normal economy, not just in the next few months, but likely over the next several years. So we really have 4 themes that we are focused on in the new normal economy that we think will thrive based off of several of those macro trends that we've been discussing. I'll talk about them briefly on this slide and then we'll go into them in more detail. But the first theme that we have our eye on is Fintech. We know that consumption is about to surge. A lot of people have been holding back on consumption because they've been at home, they've been unconfident about the economy, but now that there's reopening, they're ready to spend money. Yet at the same time, we've seen those changed consumer habits. People are no longer necessarily going to just go to brick and mortar stores and to pay with cash. We know that people are more likely to buy things online, through apps, through websites, and even kind of enjoy an omni-channel shopping experience, meaning they might want to buy from the same store in a variety of different ways. They might want to go in person, they might want to shop online. The big beneficiaries of that in our mind are the Fintech companies that are enabling those purchases. Digital payments companies that are facilitating payments both online and in person, as well as other forms of Fintech that are helping this fuel this consumption surge right now. The second theme that we see is growing very quickly, at least in the United States, is cannabis. As many states are dealing with surging government debt, they are looking for new forms of revenue. They can't just increase taxes because people can move anywhere now and work from home. Many high cost of living states can't raise taxes further. They need to find new forms of revenue by legalizing and taxing things like cannabis going forward. Third, US infrastructure development. This has been in the news a lot recently with Biden's negotiations with the Senate. But there is a unique opportunity to rebuild for long-term growth. Taking advantage of the low interest rates in the market right now, the high unemployment, and the broad support for fiscal stimulus, this really creates a unique window for the US government in particular to spend aggressively on modernizing US infrastructure. And then finally, the fourth theme that we'll discuss today is CleanTech. As we've seen over the last few years, we need more coordination than ever to be able to deal with crises at a global scale. In many ways, we could have prevented more outbreaks of COVID-19 with better coordination earlier. We don't know what the next crisis will be. It could be another pandemic, hopefully not, but the most likely next crisis on our radar is climate change. And how countries commit to addressing that today will likely have a big impact on the future. So let's talk about this in a little bit more detail. Actually, we'll start with the cannabis theme and we'll go through all 4 of these. What we might find is very interesting is, several states in the United States are facing major budgetary issues. New Jersey is expected to see a $5 billion revenue decline in 2021. Hawaii, 1.4 billion, Florida, 1.9 billion, New York, 17.5 billion. These are billions of dollars that these states are unlikely to recoup because of the changing consumer habits in their states. People have been spending less money, so there's less sales tax revenue. People have been making less money, so there's less income tax revenue. And at the same time, expenses has increased because these states have had to support unemployment and support their healthcare systems for dealing with COVID-19. Now, in the United States, the federal government has already decided to bail out many of these states. There was a $1.9 trillion relief bill passed earlier this year. A lot of that money will go to the states to help plug those gaps in their budgets for this year. But the bigger challenge is that we think on an ongoing basis, many of these states are going to continue to have budgetary challenges. Why is this the case? Well, let's look at New York City, for example. In New York, the MTA, which operates the subway system, has already been hemorrhaging money for years, even with very high amounts of ridership. What we're seeing is a very slow rebound in ridership in the subway going forward, and we don't think it's ever going to really recover to pre-pandemic levels. A lot of people just simply aren't going to be commuting to work 5 days a week. It's much more likely that it could be 3 or 4 days a week on average. So that means a massive amount of revenue decline for the MTA in New York. That means less people going to the city, less people spending money in the city, less people paying for tickets. That can create even more debt in an area that is already well indebted for years to come. So what do states do about that? Well, on one hand, you could just raise income taxes or raise sales taxes, and many states have done that. But in this environment, people can relocate, they can work from other places and not pay those taxes if they don't want to. So instead, states are looking for new forms of revenue. The best example of this is Colorado, which legalized cannabis sales back in 2014 and has generated over $1 billion in tax revenue since that legalization effort. On top of that, it's already created about 18,000 direct jobs and boosted further boosted employment by another 23% with related industries. So you're seeing that legalizing something that previously was illegal can be not only a tax revenue driver for the state, but also a form of economic creation. In the United States today, there's several states that just announced measures to legalize cannabis. Actually, 5 different states voted on this in November, and all of them approved the latest measures. This year already, major states like Virginia, New York, and Connecticut have legalized cannabis as well. And several other states like Rhode Island, Pennsylvania, New Mexico, Maryland, Delaware also have it on their legislative agendas. If cannabis is legalized in all of those states this year, more than 50% of the population of the United States will be living in a state with legalized cannabis sales. So we are at the tipping point where the wake of the COVID-19 pandemic has really pushed legalization of cannabis to new levels. Now, the second theme I was mentioning is Fintech. With the rise of consumption, who's going to win from that? And we think it's really going to be a lot of these digital payments companies in the Fintech space. But I want to dig into that in a little bit more detail. When you ask people what they want to do after the pandemic, what are some of the activities that you want to resume? It's very clear. People want to go back to restaurants. They want to be dining out. They want to travel again. They want to buy new clothing and shoes because they're going to be seeing people in person again. But then when you ask them kind of which of the following are you likely to continue of your behaviors that you picked up during the pandemic, many of them have shown that they are likely to continue their digital experiences. So even though in the short term, people might want to go back to restaurants and go shopping in person, over the long run, people are likely to continue to use new shopping methods like curbside pickup and delivery apps. They're likely to try new brands online, to shop on store websites. So a lot of those digital habits that were formed during the last 18 months of this pandemic are likely to stick going forward. Even if people are going back to restaurants and doing some stuff in person, these digital habits are likely to continue. On top of that, we're seeing from the store side of things that their habits are continuing as well. During the pandemic, many stores no longer accepted cash. This was mostly for hygienic reasons. Stores were concerned that cash could carry the virus, that it would force people to get too close to each other. So many stores, not just in the United States, but around the world, no longer accepted cash payments. They went completely cashless. Well, the percentage of stores that have gone completely cashless peaked a little bit in that initial stay-at-home economy. What we're seeing is that in many areas, the percentage of stores that are still cashless is at elevated levels compared to where they were prior to the pandemic. In many cases, the percentage of stores is about double where it was prior to the pandemic. So People are increasingly going to continue to shop online. Stores are continuing not to accept cash. This is really setting itself up for a massive rise in digital payments, particularly in the United States. One of our biggest retailers, CVS, which is a pharmacy with thousands of locations, 8,000 locations around the country, introduced QR code payments. I realize this is probably a little bit behind what we're seeing in Singapore and broader Asia, where digital payments are much more prolific, but in the United States, they're still not extremely common. But what they found was that consumers really actually enjoyed paying with QR codes, that they didn't have to bring their wallets, that they could simply scan their phones and pay for things with a QR code. So in many cases, the pandemic kind of accelerated the adoption of this technology that we think is likely to carry forward. Now, the reasons for the rise of digital payments are obvious and well known. It's convenient, it's more secure, there's more data that can be collected both by merchants and consumers when they shop with digital payments, and it can also reduce certain costs. But these specific advantages are now really being enjoyed by these stores because they've had kind of this 18-month test trial of digital payments that we think is going to continue to accelerate. Now, beyond digital payments, we're seeing other areas of fintech growing very quickly during the new normal economy as well. One of the areas on here is still very small, but you can see it on the lower right-hand side here, is buy now, pay later. Because people can buy online or are used to buying online more so than ever before, it creates new opportunities for new fintech companies like buy now, pay later companies, which effectively allow you to buy a product immediately and then pay for that product over several installments. It's really a competitive threat to the credit card space, but it's been essential that people use online ordering to be able to use this buy now, pay later system. So with this increase in digital payments and the increase in online ordering, it has really sparked a lot of growth in the buy now, pay later space, where it is becoming much more ubiquitous, at least in the United States. So as we see more consumption going forward, again, we think that the big winners here are going to be digital payments companies that can facilitate those payments no matter where they occur, if you buy in an app, if you buy online, or if you buy in person. And some other winners here could be buy now, pay later, the companies that are facilitating basically cheap credit to consumers to be able to purchase more as they get back into more purchases going forward. So the third theme that we'll talk about today is U.S. infrastructure development. This is a very, in some ways, a very politically charged theme in the United States because we live in a very divisive political environment. But we actually did a survey at Global X because we wanted to understand, how people feel about their local infrastructure in the United States. And when we asked people, do you believe that your community is in need of infrastructure-related revitalization? About 75% of people agreed that they do. So 75% of the people in the United States thought our infrastructure needs help, it needs to do better. We asked it another way, what letter grade, A, B, C, D, or F would you give your local infrastructure? Over half of the respondents gave their infrastructure a grade of C or below. So there is pretty broad consensus within the United States that our infrastructure is not good. You could even slice and dice that between Democrats and Republicans. If you ask Democrats whether you think your infrastructure needs revitalization, 82% says it does, 70% of Republicans, not a major difference. And when you look at the grade breakdowns, Democrat versus Republican, it's pretty similar as well. So of all the political divisiveness in the United States today, the agreement that the infrastructure in the US is poor is actually one of the areas that's not as politically divisive as other areas. Why is that the case? An independent body has given US infrastructure a grade of a C minus and believes that we have underfunded infrastructure by about $2.6 trillion in the United States. A few stats, 43% of our roads are in mediocre or poor condition back in 2009. 7.5% of our bridges are structurally deficient. Several people still drink drinking water that's coming from lead pipes that has been known to be very damaging to young children. We have a very old electrical grid, which is showing its age and not capable of handling distributed renewable energy. And we have poor coverage of rail and public transit, where 45% of Americans have no access to public transit. So clearly we have infrastructure that is not up to par with 21st century infrastructure in the United States. Where is that gap coming from? A lot of it's coming from surface transportation. We'll talk about these in a little bit more detail, but also across utilities, building structures, and ports and airports. How did we get to this $2.6 trillion infrastructure deficit? It largely came from just not investing enough in infrastructure, not just over the last 15 years or so, but actually since the 1960s. There's a little bit of a golden rule, which is that roughly in the United States, when infrastructure spending has been about 2% of GDP, or roughly about $400 billion a year, that's been very positive for infrastructure. When it falls below 2% a year, that's when you see depreciation of that infrastructure. And you can see for a very long time, basically since the global financial crisis, infrastructure spending has been at about 1.5% a year, allowing our infrastructure to deteriorate and get worse and worse. At the same time, we've had changing demographics with growing populations and urbanization. We've had changing technology, which has allowed us, which is kind of changing the definition of infrastructure. We've had our current assets depreciate, and we've also had increased climate risk, which has really crippled a lot of infrastructure that we use every day. So a little bit of a note on kind of how infrastructure could change in the future. A lot of this is around not just focusing on surface infrastructure or transportation infrastructure, but also focusing on digital infrastructure. The rise of 5G, which will speed up connectivity, increase bandwidth, and reduce latency, is a major piece of this, but it's not all of it. It also includes increasing public safety through connected videos. It means reducing traffic through connected traffic infrastructure. It means better use of public transportation by connecting buses and rail to the internet so people can track where they are in real time. And it means upgrading our infrastructure, our electrical infrastructure, to be smarter so that less electricity is wasted and it's more capable of handling renewable energy going forward. Now, President Biden and his administration has recognized the opportunity here because we have low interest rates and because there's a lot of support for more fiscal stimulus given the COVID-19 pandemic. President Biden announced a very aggressive $2.3 trillion infrastructure plan over the next decade. It's almost as much as that $2.6 trillion gap that the American Society of Civil Engineers has identified. Now, President Biden has created a very broad definition of infrastructure that aligns a lot with how we think about it. First, that there is a physical infrastructure component, which is much more focused on transportation, and that there's a kind of a 21st century infrastructure component that focuses on areas like clean tech and digital infrastructure that's really built for this century, not just upgrading old infrastructure. On top of that, it includes more R&D and manufacturing and innovation for certain key industries in the United States. So basically, President Biden announced this plan back in March and has since then been working with the Senate to negotiate getting this passed. Now, I mentioned that whether infrastructure is good or bad in the United States is not politically divisive, but as soon as you get into the political sphere of suggesting ways to handle it, that's when things get divisive. So when you ask people whether you think the American Jobs Plan is good or bad, it's roughly split between positive and negative. And if you break that out by political affiliation, you can see 64% of Democrats view President Biden's American Jobs Plan as positive versus only 10% of Republicans. So even though we all agree the infrastructure is bad, politically very divisive on how to get a bill passed to support building new US infrastructure. Where things stand today, we think it still is pretty positive. There was an agreement between President Biden and a bipartisan group of senators for a $580 billion infrastructure plan. That might seem very small. That's about 1/4 of the American Jobs Plan in terms of total dollars. But what's actually happening behind the scenes is that they are breaking apart the American Jobs Plan into several different bills. So the $580 billion that is likely to pass in the Senate, that is only addressing the kind of surface infrastructure, the hard infrastructure. It is not addressing the clean tech, water, digital infrastructure as much. This is likely to be passed in a second bill that President Biden uses a different political tool to get passed called reconciliation. So we are seeing progress on this theme, and we think it is going to be a multi-decade theme with billions, if not potentially trillions of dollars from the US federal government in revitalizing the US infrastructure in this post-pandemic world. Now, the fourth and final theme that I'll touch on today is clean tech and the renewable energy value chain. As I was mentioning, COVID-19 has really put into question the world's ability to coordinate on tackling major crises. And we believe the next crisis that the world will have to tackle together is climate change. So what is the clean tech ecosystem? We define it as 4 different categories: renewable energy sources and technology. So that's, solar and wind that's generating electricity and putting it on the grid. It's energy efficiency and storage, like smart grid systems, and stationary storage, like batteries. It's electrification, which includes the electrification of transportation, so electric vehicles. It's electric vehicle infrastructure. It's electrifying buildings, like heating and cooling systems. And it's also emissions reduction and carbon capture, being able to remove carbon from the atmosphere to mitigate or even reverse climate change through reducing CO2 concentration. So I can't talk about climate change and clean tech without talking about a little bit about what's happening under the hood. So very quickly, you can see in the top part of this chart, atmospheric concentration of CO2. For thousands of years in human history, it was around 200 or 250 parts per million. Now that is over 400 parts per million, which means there's more concentrated CO2 in the atmosphere. Of course, alongside of that, we've seen the mean temperature anomaly rise significantly over the last 60 years or so to over 1 degree Celsius. Now, the focus at a global level recently has been on trying to limit climate change to 2 degrees Celsius of change. That's the goal set out by the Paris Agreement. However, if we remain on the current trajectory that we are on today, it is likely that by the end of this century, that global warming could increase by 4 degrees Celsius. If that happens, there's major economic risk, potentially a 10% reduction in total economic output. There's major risk of coastlines and the 800 million people that live near the coast due to flooding. The number of natural disasters is likely to increase. It's already accelerated significantly over the last few decades, but billion-dollar climate events are likely to be more and more frequent. And then, of course, lethal heat. 30% of the global population faces severe threat of increased temperatures if we see overall mean temperatures rise by 4 degrees. So it's not something we want to have happen. What is the antidote? The antidote is clean tech and renewable energy. Estimates hold that to be able to limit climate change to less than 2 degrees Celsius over the next 100 years could take a total investment of $110 trillion spread between renewables, electrification and infrastructure, energy efficiency, and reducing fossil fuel usage. $110 trillion, just to put that in context, is roughly equal to the total amount of the global market cap in the entire world of all equities. So it is a massive amount of investment that's required. It will require a major shift in electric production to wind and solar and hydro and geothermal so that we can continue to increase renewable shares of electricity production. But it also goes beyond just electricity production. Electricity production is only, a piece, only about 27% of total emissions. Other areas like electrifying buildings, electrifying transportation, changing agricultural practices, all of these need to happen in coordination to be able to reach carbon neutrality over the next few decades. Now we're already seeing progress. We're seeing solar installations increase. We're seeing consumer attitudes change to be more supportive of solar and other renewables. But the major change that we need to see going forward is to be more government action. That government coordination in the wake of COVID-19, being able to coordinate with other countries and say, we are going to set aggressive climate change goals. So far, we have seen an increase just in the last few months of government commitments to this space. China has committed to reaching carbon neutrality by 2060. Korea and Japan and the United States have committed to reaching carbon neutrality by 2050. There's also several countries in Europe like the UK, France, and Germany that have made similar commitments to reaching carbon neutrality. But the major thing is going to be government policy and supporting that. This goes a little bit back in the United States to the American Jobs Plan with President Biden, but setting aside federal money to invest in climate change is going to be key to accelerating that shift to carbon neutrality so that electric vehicles are more prominent, so that renewable energy production becomes more prominent and more scalable, and that we can actually achieve these goals over the next 3 decades. So I do want to leave time for about 10 minutes or so for questions, but I did just want to wrap it up with some key takeaways. First, what we saw through the pandemic already in the stay-at-home economy and the reopening economy was that this unique period has really accelerated the adoption of several themes. In the stay-at-home economy, it was the rise of digital experiences and shopping. In the reopening economy, it was the rise of companies that are promoting safety and flexibility. As we enter into this new normal economy, we're not so focused on the health risks anymore, but we are going to be focused on the lasting economic, consumer, and government impacts of the pandemic. So we believe that the 4 themes that are likely to benefit in this new normal economy going forward, we talked about them: cannabis as states deal with rising levels of debt; fintech as we see a surge in consumption, but a consumption that happens both digitally and in person; further spending in US infrastructure development as the US takes this opportunity to reinvest in its infrastructure; and finally, clean tech as governments around the world focus on the next impending crisis and try to tackle it together. So if you appreciated this research, you can see it at globalxetfs.com/research. And I am going to show a couple disclosures, but then I'd be happy to take any questions that come in here. So I'll just review a couple of the questions coming in, and maybe actually I'll stop my screen share so I can review the questions going into the portal here. Okay, this is a really good question. Can you share with more specifics what's in the infrastructure plan that will increase USA competitiveness in the long run rather than just a short-term burst to GDP? That's a really good question. So we believe that the stimulating impact of infrastructure development is likely to be both short-term and long-term. So in the short term, it's going to require hiring tens, if not hundreds of thousands of people to build out infrastructure. It's going to require purchasing several commodities in the United States, whether that's cement, whether that's copper and steel. It's going to require more manufacturing in the United States to build sophisticated buildings and clean buildings going forward. That all pumps more money into the economy immediately, but the long-term impact of that is very stimulating as well. McKinsey actually estimates that the long-term impact for every dollar that goes into infrastructure spending, the return is about 20% higher GDP forever going forward. So a dollar basically results in 20 cents more of GDP in perpetuity going forward. That's a very large return on investment for government spending. There's several reasons for this. Simply, better transportation systems means more efficient transport of labor, goods, and services. If you're not spending time in traffic, you're working longer, or you're shopping more, or you're spending more time with your families, all that can have kind of a positive impact on the general economy. Similarly, with digital infrastructure, the better our digital infrastructure, the faster our internet, the more productive people can be, and the more technology can accelerate. So that is really the long-term case for infrastructure development, is more efficient systems. However, on top of that, a piece of this infrastructure bill is not just really focused on infrastructure in the traditional sense. A lot of it is focused on increasing the US's competitiveness in other areas. Recently, the US passed the US Innovation and Competition Act, which funds about $250 billion into areas like AI, semiconductor manufacturing, cybersecurity, really a massive stimulus plan for accelerating technological advancement in the United States. So it's being wrapped up a little bit in the guise of infrastructure, but in reality, it is a way to make the US to continue to be more competitive in technology going forward. So just to kind of answer that question, I do believe that the infrastructure bills that are coming out in the United States will have a long-term impact on increasing the US's competitiveness going forward. A lot of questions about kind of like top picks within US infrastructure development and clean tech. I won't talk about company names specifically, but I will talk about some areas that we think will benefit in US infrastructure development. I think there's a little bit of a misconception in the market that owning physical infrastructure is the way to play this theme. Physical infrastructure in the United States is largely limited to utilities and energy companies, but we don't see those as the big winners from this bill. Those companies already operate infrastructure. That infrastructure already works. They're not necessarily going to be the recipients of billions of dollars from the federal government. Instead, we believe the big winners are the companies that are going to be building the new infrastructure or repairing existing infrastructure. So those would be companies involved in construction and engineering that manage large-scale projects in the United States. That includes transportation companies, such as rail companies that are moving goods around the country. It includes commodities that are being used in infrastructure, like cement and steel and copper. And includes heavy machinery companies that are building the machines that are going to be used in all of these infrastructure projects. We believe this is kind of a more upstream way of viewing the theme, really focused on the companies that will be recipients of those billions, if not trillions, of federal dollars going forward. So it's a little bit of a different segment than traditional infrastructure because this is the builders of infrastructure that benefit rather than existing infrastructure assets. I guess a follow-up question is your views on infrastructure development only specific to the US or is it applicable to the world? That's a really good question. So in many ways, the themes that are driving infrastructure in the US are applicable to other countries as well. The need to increase employment, the ability to take advantage of low interest rates, the GDP output gap, that is a commonality that is being seen in many parts of the world today. We have seen that Europe has also expressed interest in investing billions of dollars in its own infrastructure, so Europeans are coming up with similar plans. So this is not purely just a US focused theme. I'm personally very focused on it from a US perspective, but I would not be surprised to see a European version of infrastructure development going forward. And of course, what we've seen, really since, the beginning of the pandemic and other economic crises is that in China, they use infrastructure spending as a way to stimulate the economy as well. So if China believes there's a need for more economic stimulus, we could see more spending in China as well. So it is actually a fairly global theme, though I think the US is a little bit more unique, not in the sense that it needs infrastructure more than others, but our infrastructure is older than many other countries and has been so grossly underinvested that there's a huge benefit to investing in US infrastructure today. So I think I just have time for one more question here. So let me switch over to Zoom and see if there's any other questions. How much of these carbon neutrality comments by various countries are greenwashing? I don't think the carbon neutrality comments by countries is necessarily greenwashing. I think these are actual attempts to stimulate policy to achieve these goals. I think of greenwashing as more kind of disingenuous efforts where, a company might try to tout that they're doing something great for the environment, but they're really not, or they're trying to be kind of lumped in with sustainable investing when they're not. I think that these aggressive government policies for reaching carbon neutrality are a starting point. They're necessary to be able to rally their governments around doing what it takes to achieve those goals, whether it's more funding, whether it's more R&D, whether it's more partnerships. I do not believe that these are simply attempts by governments to kind of score points to sound good. I don't think there's a huge benefit to these governments to do so. I think it really is about setting a starting point and setting aggressive goals for tackling climate change. So I am pretty optimistic about it. Also, I'm seeing a question, would it be possible to request a copy of the slides? Absolutely. I think Philip has the slides and should be able to share those. So I see it's been 45 minutes. I think that's all the time we have here. Thank you all for listening. Thank you all for the great questions. Really appreciate the opportunity to speak with all of you today and looking forward to speaking with all of you again sometime in the near future.